Hi everybody, Irwin here. I'm sure you remember me as your lecturer for the SCA BG module, right? Business Value and Governance. As we all are aware, SCA has released the exam guidance for December 2020. And within it, there is an interesting point on being familiar with leases and comparing it against buying an asset. So either you lease or you buy an asset. Now this is not really a point that was developed deeply in the candidate learning pack, nor in my lectures as well. This is something that is taken as information that a student is assumed to already have, assumed knowledge. But let's quickly go and revise this. So when it comes to a lease or buy decision, what do we have to consider? Number one, what are the advantages of leasing? And as we go through these advantages, it would be the disadvantage of buying. Right? Very often the advantages of leasing would be the disadvantage of buying. So if we lease, we avoid the initial upfront payment. Buying requires you to put the money down right at the beginning, while leasing spreads it out, right? You also avoid obsolescence risk when you lease because you could always terminate a contract and get a newer model, a more advanced asset. And lastly, not to forget, the rental or lease expenses qualify for tax deductions. So those are the advantages. Now what would be the disadvantages? Disadvantages, if we lease, there are no capital allowances possible, which might be a disadvantage if the government has very favorable capital allowance policy for a specific asset, right? Because they want to encourage investment in that asset. So if we lease it, we do not avail ourselves to that very advantageous capital allowance policy of the government, right? So we have to give up capital allowances. There are no capital gains possible, and also keep in mind, you are not able to dispose or get scrap value from this. No disposal value, no scrap value if we lease. And of course, a qualitative factor, you are restricted on your control over the asset once you are leasing instead of buying. Now, so those are the areas to keep in mind. How do we compare them quantitatively, right? We would then use same old net present value calculations, NPV. When we use NPV calculations for lease versus buy, our goal is to see which is the better deal. Should I lease it or should I buy it? In simple terms, which one is cheaper, right? So NPV will show us which one is cheaper. How do we do it? First step, place all the relevant cash flows for each option within the spreadsheet. So later you would see a spreadsheet, okay? As you do so, always keep in mind, often cash flows will be linked to certain tax effects or tax deductions. So keep that in mind. Second, once we place it in a spreadsheet, we do it in the NPV format and we discount it by the cost of financing. And do keep in mind, please, the after-tax cost of financing, after-tax cost of debt. Okay? When we have discounted them and brought them to net present value, we then select the option with the lowest cost. This would be shown by the least negative NPV. All your NPVs would be negative because we are comparing between two ways of acquiring something. And acquiring something means we are paying, right? Two methods of paying. So outflows, cash outflows, NPV would obviously be negative for both of them, right? Okay, so what are the common mistakes in a question? One, students forget to use the post-tax cost of debt. They discount it with some other rate. Okay, or they forgot to put it as post-tax, they use it as before tax. Okay, common mistakes. Second, adding revenues of the machine to the cash flows. Now, we do not need to know how much this machine can make us. We do not need to know that. Why? I want to find out which is the cheaper way to acquire the machine. So I do not need to know what that machine can produce. My focus is, if I get a machine, which is the cheaper method of getting it. So we exclude the revenues since our objective is just to compare the costs. And finally, select the more negative NPV. That is a very common mistake, right? So I have two NPVs. One is negative 1 million, another is negative 1.2 million. Students are so used to taking the bigger number, they go for the 1.2. But 1.2 is very negative. No, this is actually bigger, right? Negative 1 million is bigger than negative 1.2. Right? Negative 1.2 is going backwards, right? So we want the cheaper option. Always choose the cheaper option, paying 1 million NPV versus 1.2, right? Okay? So keep that in mind. Some students accidentally will choose this. That would be a mistake. Alright, so let's go now to the question. The question in our example, and later I would walk through the Excel spreadsheet with the answer key. Alright, so we have BG Co is deciding whether to lease or buy. Okay, so I have my choices in front of me, lease or buy. The machine will have a useful life of 4 years. If we do buy, it will cost 90,000 to buy, a sum which BG Co would have to borrow. After you buy it, wait for 4 years and you can scrap it for $10,000. This is specific to buying. Alright? If you wish to lease, sure, you can lease it for 28,000 per year for 4 years. Now watch out, leases may need you to pay at the start of each year. Which means if we do lease, our very first payment will be at year 0 or now. In terms of time value of money, that matters, right? Okay? Now, if the machine is bought, maintenance cost of 1,000 per year will be incurred. This is only if I buy. It will not be incurred if the machine is leased. So here I have my respective cash flows for buying and leasing. Alright? Next paragraph says the machine, if acquired, is expected to increase production by 10,000 units per year over its useful life. The products can sell for $18, variable cost $9, which means this product, I sell it for $18, it costs $9 to make, it gives me a $9 contribution. The C here stands for contribution, right? So it adds to my cash flow $9 per sale. But remember, this is not needed when I'm comparing buy or lease. I do not need to know how much this machine makes. Buy or lease, I need to know which one is cheaper. That's all. Okay? So, BG Co pays corporate tax at 30%. Alright? Capital allowance 25%, reducing balance. Your tax is payable 1 year in arrears. The company intends to finance the acquisition of the machine using a loan that pays before tax interest cost of 10%. Now this is misleading. I do not want before tax when I do my calculations. I would want after tax. So after tax would be your 10% times 1 minus the tax rate, 30%. It would be 7%. 7% would be my after-tax cost of debt. Okay? So a reminder, your tax rate here is 30%. So we should now be so familiar with all these calculations, right? Okay? Last line says, BG Co uses an after-tax cost of capital of 11 for appraising new investments. Okay? That would be for an investment decision. Right now, question A says, based on financing cash flows only, determine whether BG Co should buy or lease. So which is cheaper? Should I buy or lease? Now let's look at the answer key. You will have the answer key sent to you. You may already have it. Let's walk through the answer key, okay? So first, I'm going to use green ink. We're going to start with looking at what are the costs of buying. So if I buy, straight away pay $90,000 for the machine. I qualify for capital allowances. This table shows me the capital allowances. And another thing that we should be entirely familiar with, right? As we ready ourselves for the exam. Do watch out, when I buy the machine, I can scrap it for $10,000 at the end. So that naturally affects the capital allowances and tax claim that I get. Okay? So, since tax is payable 1 year in arrears, watch out for that, right? Since tax is payable 1 year in arrears, what would occur is, in year 1, I do my capital allowances, but I only get the cash flow in year 2. And we start to see it here. 6750, 5063, 3797, 8391, tick, 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 tick. Okay, so those numbers there are quite clear. Watch out for the disposal. This tends to be forgotten. Students tend to forget this. Alright, so always put in your template purchase dash scrap or disposal. It would remind us 90 to buy, 10 to scrap later on. Look at the maintenance. The maintenance here, $1,000 is the maintenance. If you decide to buy the machine, you have to maintain it yourself. Now, there would be a 30% tax effect. So you get $300 1 year later as part of your tax savings. So the workings here, I will not touch on them. I do assume, of course, that you have your basics. I'm just walking through certain key areas. Okay? Feel free to email me if some of the workings by the side, you have forgotten them or you're not familiar with them. But I have confidence that most of you will have no issues, right? So let's look at another thing within buying. Your discount rate is 7%. Remember the after-tax cost of debt here? 7%. Well, now we use it. Okay? So we will do this and we would then work out our NPV, discount all your cash flows, get your NPV. This is the NPV of buying. Okay? Now what about leasing? Leasing is even easier. Leasing is like, what's up, man? It's so easy. You just put the cash flows for leasing. Okay? 28,000 for 4 years or 4 payments of 28,000. So you see it appear 4 times. Now some students will ask, why is the tax saving only happening in year 2? Why not happen in year 1? Now this is because your payment is at the beginning of the year, right? So we assume here, of course in the exam, watch out, it may be a different assumption, a different set of instructions. But in this question, I am paying my lease at the beginning of the year, January. Now, can you run to the tax office in January and file your claim? No. Most of the time, we take it that we file our claim at year end, right? This is where I put in my tax papers. So the 28,000, even though I paid it, I have to hold my horses because I have to wait till December, which is around year 1, end of the year, I file my tax papers with the government. I file it with IRAS. And we then have to wait 1 year. So therefore, by the time it is processed, my tax saving comes in, 1 year in arrears, 8,004 happens in year 2. So, in essence, people, 1 year to hold your horses and wait just to file it, then 1 year in arrears to get your tax savings. So once you know that, you look at your lease is 28,000, the tax savings on it will be 28,000 times 30%, 8,400 as you see in this portion here, 8,004, 8,004, 8,004. Alright? Discount it by 7% again, you get the NPV of leasing. As you can see, which is cheaper? Buying is negative 65, Leasing is negative 74. Clearly, buying is cheaper. We should buy. The costs are lower in buying, right? Now, that is the question on lease versus buy. So should I lease or buy? Answer, we found out in the calculations, we should buy. Now, what if they extend the question? Now they say calculate the net present value of buying the machine and state whether you should really buy it. So now you know buying is the more advantageous method, but question still remains. Should I even buy it in the first place? Does it make me enough money? Is this a worthwhile investment? People, this is an investment question. Is this a worthwhile investment? For that, I have to use this portion here. Right? 10,000 units per year. That is the improvement I will get. Okay, fine. I'm going to get 10,000 units. If you recall, each unit will give me $9 of cash flow, right? Sales minus variable cost, $9. So basically, I'm going to get 90,000 extra cash flow. If I go with this machine, should I? Is it worth? Now, let's look here. When it comes to an investment decision, notice, all you need to do is copy and paste the buying cash flows. So they are asking, should I even buy it? Put in the buying cash flows. The buying cash flows are literally a copy and paste. So look, 90, 1000, 6050, 4363, so on and so forth. They are a copy and paste of the cash flows from the buying here. Okay? Alright? 90, 1604, 4363, so on and so forth. Alright? They are literally a copy and paste from above. So you just copy and paste the cash flows from here. Alright? I'm just simulating it. And you bring it down. You place it like this. Now, after you have copied and pasted the cash flows for buying, you look at what are the benefits of this machine. Notice here, the contributions. You get 90,000 every year for 4 years, right? And this 90,000 comes with the tax flows. Once the government is aware you are making 90,000 more, it's gonna tax you 30% on it, right? 27,000. So 1 year in arrears, 27, 27, 27, 27. Now, you will then get your total cash flows for buying the machine. After you get your total cash flows, use, as the commentary says here, use the investment rate, not the financing rate. So you would notice we are using 11%, not the 7% of earlier. And with that, you then calculate your NPV for all the cash flows. If the NPV is positive, this machine is a good project, earns us what we need, let's invest in it. So with that, people, I don't want to stretch the video for too long. This is a walkthrough of lease versus buy. If you have any questions, any concerns, you know my email address, right? It is irwin.luo@kaplan.com. Just write to me and I can address your concerns, okay? So thank you very much. In case I don't get a chance to see you and wish you directly, I want to wish you now all the best for the December exams, okay? Take care, everybody. Bye-bye.